Right now, looking at the close from November 26th, Opendoor Technologies Inc. is trading at $7.78. That is a slight nudge upward of 4 cents, or 0.52% on the day. However, the after-hours session has peeled back those gains, with the stock sliding 6 cents to $7.72, a drop of roughly 0.77%. When you see a stock like Opendoor fluctuating in this tight, nervous range, just under $8, the immediate expectation is that the market is waiting for it to finally die, to succumb to the high interest rate environment that has frozen the housing market solid. The common narrative on Robinhood stock trading feeds and bearish blogs is that Opendoor is a relic of the zero interest rate policy era, a cash-burning house flipper that is holding a bag of depreciating assets while mortgage rates suffocate demand. They see a zombie company walking. But the reality is far more aggressive and technically nuanced than a simple failed flipper story. The reality is that Opendoor is currently undergoing one of the most radical internal hard resets in Silicon Valley history, often referred to as Opendoor 2.0. While the casual observer sees a stagnant stock price, the deeper reality is that the new CEO, Kaz Nejatian, is actively dismantling the old consultant-heavy operational structure and replacing it with a lean AI-centric software engine. This isn't just a pivot. It is a refounding of the company. The market is pricing in a bankruptcy risk that might be rapidly diminishing as they shift from brute force buying to precision liquidity. That $7.78 price tag isn't just a number. It is the battle line between those who think housing is uninvestable and those who realize that in a frozen market, the only player offering instant liquidity becomes the kingmaker. Let's dissect the intraday action leading up to this close. The volume was elevated but controlled. On Interactive Brokers charts, you would have noticed that the stock refused to break below the $7.50 support level despite the broader market jitters. This tells us that there is a floor of institutional accumulation here. Why would institutions buy a broken stock? Because they are looking at the warrant dividend and the recent inclusion in the S&P Global BMI Index. These aren't sexy headlines for the evening news, but for Fidelity Wealth Management strategies, they are signals of structural maturity. The warrant dividend, in particular, is a fascinating piece of financial engineering. By distributing tradable warrants to shareholders, Opendoor essentially created a loyalty test and a potential short squeeze mechanism. It forces short sellers to account for these new instruments, adding a layer of complexity and cost to betting against the company. The stability we saw today, holding that green close despite the macro headwinds, is likely the result of this new capital structure digesting the volatility. If you're sitting there with your SoFi investing app open, staring at the chart, you might feel the vertigo of the last few years. The stock was once a triple-digit darling, and then a penny stock prospect. But investing is about future cash flows, not past trauma. The expectation is that Opendoor needs a booming housing market to survive. The reality is that Opendoor might actually function better in a difficult market, provided their pricing algorithms are accurate. When houses sell themselves in 2 days with 10 offers, nobody needs Opendoor. You just stick a sign in the yard. But when houses sit for 6 months, when sellers are desperate to move for a job or a divorce and the traditional market is dead, that is when the instant offer value proposition skyrockets. The recent flattening of the stock price suggests the market is beginning to understand this counterintuitive thesis. Chaos in the traditional housing market is Opendoor's customer acquisition engine. Let's talk about the AI component because every company claims it, but Opendoor is structurally dependent on it. The old Opendoor relied on armies of human estimators and operational bloat. The new Opendoor is trying to automate the pricing and inspection process to a degree that was previously thought impossible. They're using computer vision to assess home condition from user-uploaded videos. This reduces the cost to acquire significantly. If you're managing a self-investing portfolio, you have to look at the contribution margin. That is the metric that matters. In the recent quarters, despite the revenue drop, the focus has shifted to unit economics, making sure every single house flipped actually makes a dollar rather than just chasing volume for vanity metrics. The stock is hovering at $7.78 because the market is waiting for proof that this AI estimation is actually working at scale without blowing up the balance sheet. For those of you using Schwab Intelligent Portfolios or similar automated systems, Opendoor is likely flagged as high-risk speculative. And it is, but the risk is evolving. It is shifting from existential risk, will they go bankrupt next quarter, to execution risk, can they scale the new model? The bankruptcy fears have subsided slightly due to their cash position, still sitting on nearly $1 billion in cash and equivalents. That is a massive runway. In a world where SoFi stocks and other fintechs are fighting for liquidity, Opendoor's cash pile gives them the ability to weather the storm that their smaller competitors cannot. This consolidation of power is the hidden bullish divergence. They are the last major iBuyer standing after Zillow and Redfin exited the game. Being the last survivor often means you inherit the entire monopoly once the market turns. Comment below how many shares of Opendoor you currently hold, and are you planning to exercise those warrants if the stock hits the strike price, or are you just holding the common stock? Now, consider the macro environment. We have mortgage rates stuck in the high 6s or 7s. The lock-in effect is real. Nobody wants to sell their home with a 3% mortgage to buy one with a 7% mortgage. This has crushed transaction volume. This is the bear case. But look closer at the reality. Life happens. People die, get divorced, or get transferred. There is a floor to housing turnover that cannot go to zero. These must-sell sellers are Opendoor's prime demographic. They value certainty over maximizing the last penny. The recent price stability indicates that Opendoor has found this base load of volume. They're not trying to buy everything anymore, they're trying to buy the right things. This discipline is what the new CEO Kaz Nejatian is preaching. If you read the transcripts, he sounds less like a real estate mogul and more like a software engineer optimizing code. He wants to turn the house flipping process into a deterministic software loop. Let's look at the short interest. Opendoor has a massive target on its back. The short interest is consistently high. This makes the stock a coiled spring. If we get any positive shock, a surprise Fed rate cut, a sudden drop in Treasury yields, or an earnings beat where they show positive GAAP net income, the rush to cover could be violent. The after-hours dip to 772 might lull shorts into complacency, thinking the momentum is dead. But as we saw with Robinhood crypto markets or GameStop sagas, high short interest combined with a stabilizing business model is rocket fuel. The warrant dividend adds a layer of gamma squeeze potential to this, as market makers have to hedge their exposure to the warrants. The comparison to Tesla stock is often made, not because of cars, but because of the disruption model. Tesla bypassed the dealership network. Opendoor bypasses the real estate agent network. The expectation is that agents are essential. The reality is that for a standard cookie-cutter tract home, an agent adds very little value compared to an algorithm. Opendoor is betting that 80% of real estate transactions can be commoditized. If they are right, the current market cap is a rounding error compared to the total addressable market. Real estate is the largest asset class in the world. Even capturing 1% of the U.S. housing turnover profitably would make this a massive company. The stock price today reflects a probability-weighted outcome where the market thinks they have maybe a 10% chance of succeeding. If that probability shifts to 20% or 30%, the stock doubles or triples. If you are using Fidelity Investments research tools, you will see that analyst ratings are mixed. often leaning towards hold. And this is typical for a company in transition. Analysts hate uncertainty. They want a straight line. Opendoor is a jagged line. But for the individual brokerage account holder, jagged lines are where the opportunity lives. The key metric to watch in 2026 is inventory turnover. How fast are they clearing the homes? If they can turn a house in 90 days in a bad market, they're printing money. If it takes 180 days, they're losing money to holding costs and interest. The recent data suggests they're getting faster even with the lower volume. This efficiency gain is the silent killer of the bear thesis. We also need to discuss the partnership angle. Opendoor has been integrating with home builders and online portals. Imagine a world where you go to a Zillow listing, Opendoor partners with Zillow now, and